Tyler, how's it going?
Dave, what's going on, man? How you doing?
I'm doing excellent. So been a busy it's been a busy like month here or so on the deal flow world, which has been exciting. It always ebbs and flows and kind of what's out there and what's working. And in the past month, there's been a bunch of opportunities out there. So that's part's been pretty exciting. So
It's been good, man. I mean, I'm expecting a lot of opportunity to pop up here in the next, 6 to 12 months. It's going to be interesting to see where the world heads now that it seems like investor confidence is coming back, lending confidence is coming back. I've had lenders calling us, asking us if they could give us money, which is pretty nice because they're having a hard time funding deals. And look, those guys only make money when they're putting money out. So it's exciting to see.
yeah. Yeah, the debt front and lenders it's been kind of a roller coaster for the past 5 years of how that stuff has played out, what banks are willing to do, what they're working on getting out of. We've got one of our main commercial lenders that we did a bunch of medical deals with, kind of all over the Southeast. We were doing stuff with them. And then they decided that, hey, they don't want to be doing that. They're only going to lend to people that are based in North Carolina and they don't want any medical exposure. So it's like, okay, not sure, how those kind of decisions as banks, aggregate together and they've got to balance their lending pool of where they're at. They're always changing what they're willing to do.
Yeah, and those buckets fill up at different times, right? I mean, a lot of people don't understand how banks work. Like they literally have designated buckets, certain amounts of cash that they can lend towards certain types of projects, right? Self-storage, hotels, hospitality. That bucket, for whatever reason, always seems full at every bank I talk to. Multifamily, commercial, right? Owner occupied. That's why banks love owner occupied. They basically have unlimited funds for that. Yeah, every bank is always different. They may love a project, but if they don't have any room in that bucket, they can't lend on it. So that's why it's important to maintain those relationships and always be talking to banks.
Yeah, we're always, we're looking to do different types of deals all the time. And then it's always like, oh, I wonder who's going to be interested. The bank's really like one of your largest investors, a big partner in the deal, making sure it happens. You need, well, it'd be great if you didn't need financing, but financing definitely helps the equity side returns. So finding partners that can help with that is pretty critical.
Yeah, I mean, it's so important to treat banks like that too. I mean, I was texting my lender on my hotel yesterday, giving him updates on where things are and how it's going. And that's certainly not a requirement, right? I mean, just because you're borrowing money from a bank doesn't mean you have to text them and give them updates. They're not going to require that of you, but I like to do that because one, it's a relationship. Two, I want him to lend me money in the future. And three, he's the biggest partner in the deal. I want him to know how it's going so that it counts as a big win for them too every time we hit any big milestones.
Yeah. With interest rates, I mean, interest rates have come down a little bit in what we've seen. So we're seeing lending that can be done in the, we had 2 loans that hit in the 5.9% range. Now, none of that's multifamily. Multifamily is normally the most competitive interest rates that are out there. But on the commercial side, in the low sixes is kind of where we're at right now. But we're also still seeing, it's still a little tough to get the full lending done. And there's a lot of more private options on the lending side that are out there now that are not a bank. Are you seeing that stuff too?
Oh man, I mean, it's post COVID, but really probably post like mid 2022, you started to see all of these additional funding options pop up, right? Because investors still have a lot of faith in real estate, but banks had to pull back. And so you started to see a lot of debt funds popping up, a lot of private lending popping up. And you and I have had this conversation before, but I can see a future where banks and the way that they have traditionally been lending money almost become obsolete because the private market might be able to compete with them in many different ways. It's interesting the different approaches that private lenders can take compared to a traditional bank. So it's exciting to see.
Yeah. We did a loan on a project with essentially a debt fund. They were someone that would come in and do 6-month interval loans where we could get an extension and do another 6 months. I mean, it was a deal we're looking at selling. So, we didn't want to go through a fully expensive refinance, a full position. We're like, hey, we only need 12 months total on this. So it's basically like 6-month revolving loans. And the interest rate was a lot higher, but it was interest only. There were a lot less fees. There was a lot less work to get everything done. So it made sense total cost wise when you're looking at the loan to do that and pay a 9.5% interest for that shorter amount of time. Right.
Yeah. I mean, I think that's That's exactly where the private lending comes in. There are gaps in the debt market that need to be filled that either traditional banks can't fill or won't fill for various reasons.
Yeah. And one of those two is just smaller balances. We've done that on our side where, we're talking with other operators. We've sold some deals where people are like, hey, we need $500,000 to do, we're gonna take the deal that we bought from you and we're gonna renovate it more. We're gonna do this with another similar type asset. And they're like, it is hard to go find an option for how do you fund that if you don't have just the pure equity check to do it. So we've done a few of those deals where you're directly lending on an asset that doesn't have debt and you're the first position loan and you're like a 10% loan to value in a first position, but it's still beneficial for them to do it versus trying to go out and get a full loan on a deal.
Well, and you know what's interesting too is that this is so common in the residential market. It's very uncommon in commercial. There are all sorts of different private money lenders, transactional funding. There's a lot of different opportunities in the residential world. You think about fix and flips. Sometimes lenders will give you up to 90 or 100% sometimes on those based on what the ARV is. And you just almost never see anything like that in the commercial world. And so I think there's a huge opportunity for the right debt group or the right private equity firm to come in and start creating loan packages like that.
Yeah. Yeah. So we've done about $10 million of investments into other real estate operators where we're simply providing almost like it's debt, but it's more like preferred equity. We're getting an interest payment on a monthly basis, and we only have a 12 to 24-month commitment out of that obligation because it is low leverage and they're looking at going and doing something else with the deal very quickly. They're not looking for a 10-year, note with a fixed interest rate long term. They're trying to see like, hey, we need something that kind of bridges the gap right now so we can finish the next phase of this project, whatever it may be, and then move on from it.
What do terms like that look like? Like on a deal like that where you're coming in and maybe you're kind of this pref debt, pref equity kind of position. What are you typically going for in terms of security, in terms of returns? Like what makes those deals make sense for you?
Yeah, we're tying it to the actual asset that's there to make sure that we have it, recorded on that asset, but we're gonna get a current pay amount that's in the 10 to 11% range, and then there's going to be a fee on the exit of it. That's basically like somewhere around like a 2, 3, 4% fee that gets paid at the end. So it is expensive, but it's short term. You can pay it off at any time. There's no fees going in. There's no monthly processing fees. There's none of that stuff. There's no principal pay down. So overall, it's beneficial from like a total cost of debt standpoint, and it's pretty flexible and short. But most of the stuff we're doing on that in that world is this 12 to 24-month period without long-term commitments, and you can move pretty quickly on it. As long as you understand the real estate, you know who the operator is, and you're in a good position on it. We would not do something where like, hey, we're the top 10%, right? Like your third position, you need money to pay down AP. Like that's not interesting. That interest rate is going to be incredibly high. I don't know if there's anyone that would do that. They probably shouldn't do that, but
No, it's just too risky. With that being said, obviously everybody always wants to be in first position. Under what circumstances would you consider a second position?
just depends on the loan to value. Like if they have a first position loan where it's 25% loan to value, 30% loan to value, it's like, okay, maybe we come in as a second position depending on what the exact business plan was. We did one of those where a person bought a multifamily asset, but they bought it like 80% cash, 20% debt, right? Most people were trying to leverage up as much as possible. This person was not interested in doing that. But they wanted to get some loan proceeds or some capital that they could use to do a renovation and then refinance the loan and take all that out. Uh, so essentially paying off two loans at one time. They did that. They did it quicker than they even projected, and they didn't get a full loan to pay it off. They used equity to pay off that balance as well. Um, and they left their deal in a very healthy, leverage position. So that's someone we would do that with again, just because they are in the camp of, hey, 70% equity in a real estate deal is good for them. And that's a very conservative buyer. That's a conservative operator. They are the owner, they are the self operator. So we like trying to find those partnerships where people are view real estate in that fashion. He will hold
Yeah,
that deal for a long time and be a good
well,
operator.
there's a ton of operators out there that are funding deals like that, right? I mean, if you're in a 1031 exchange, you've got to spend all of your equity, right? And so if you you place a 70-30 or 80-20, in favor of equity on a property, you're probably not going to want to go through a full refinance just to, finish out some renovations, lease it up, because then you're going to have to refinance again once you're stabilized. So why not go for a shorter term, mezz debt situation and get the funds there and then refinance once the deal is done and stabilized, that we only have to go through the process once.
Yeah. Yeah, the refinance costs are it's a lot now. Like, I mean, you talk about, like, inflation and pretty much everything you see in the world, but the cost of doing a refinance has grown tremendously over the past couple of years. Just from the legal fees, recording fees, all the fees that go into it, you're gonna be paying 3% of the loan balance at least to get that loan done. And if it's a, you know, couple $1,000,000 loan, it's like that adds up. You know, if you can do that once versus twice, you're gonna save a lot of money.
Yeah, well, I mean, and aside from the fees, it's just the process, right? I mean, the actually going through the full process to get a project refinanced, like you kind of just want to do that one time, you know? We want to do it twice in 2 years or twice in a year. It's just
Yep.
such a pain.
Yes.
Matthew's saying, howdy guys. Good job doing this. Welcome, Matthew. Glad to have you here, man. Thanks for joining us. So,
Yeah, we
Dave, how do you evaluate these opportunities? Because coming from we've got a lot of equity investors, a lot of investors out there that are accustomed to coming in as an LP on the equity side of these real estate opportunities. What does that look like from a debt value evaluations perspective, though?
yeah, you really got like it's a completely different picture on how it works. I mean, a lot of people like the real estate story. You're gonna come in, you're gonna do something, you're gonna see it improve, and then you're gonna sell it and realize those gains. The debt side, it gets to watch that happen, but it doesn't get to benefit from the upside that's gained there. However, it is going to get the monthly distributions during that time frame. So, I don't think it's bad to be an investor in, you want to diversify in what you're doing and stuff, but looking at real estate in multiple different ways. The debt side is good because it does give you exposure to what's going on, and but that exposure is really resulting in just a higher coupon that you're able to receive on a monthly basis. But you are going to get, if everything goes well in the deal, you're getting paid off in that 12 to 24-month period, but you're not seeing any equity upside. You're only seeing, hey, I've received that interest, if it's 10, 11, 12% for that period of time, and then that's it. And then you're getting your capital back. So the more if, anything on the debt side that you're investing in, any kind of fees that go against that 10, 11% really hurt your overall returns. So if you're, you know, in the debt products that we've done when we've gone out and done it, it's got to be a very, very efficient model where the cash flow that comes in from a debt payment is being immediately distributed to the investor side of the deal. They do not support a high GP fee structure, front end loads, back end loads. That's going to just wipe out the cash flow. You might as well just go buy heck a CD if you're going to reduce your cash flow to like 4 or 5%. Wouldn't make any sense to take the risk and do it. Uh, so it's got to be a very lately feed product that's going out, right?
So if I'm a typical LP investor, I've got $500,000 that I want to allocate into LP equity investments and into maybe a private debt fund. How much would you recommend I allocate into each bucket, and what kinds of returns should I expect from each?
Well, if you're going the pure equity route and that IRR target of what you're looking at, that's like a totally different bucket. You know, I like that exposure, I personally like the idea of, hey, if I have some money in the debt side of it and I'm getting a monthly check, like that's a nice way of looking at it. You can think about returns, but man, the idea of if you have more checks coming in on a monthly basis than you have going out, it's a good spot to be in. So
Yeah.
trying to kind of get more checks coming in is positive. So I like having some to it, but I think it's a little tricky for each. What's your like recommended allocation of it? But I do think if you've got a lot of real estate deals that are invested in their long term and they're sale driven, and you're not getting any monthly cash flow out of it, throwing in one or two debt ones in there where you're going to get, monthly distributions certainly helps. Right.
Yeah, it doesn't hurt at all.
Yeah. It's like,
No, that's for sure. I mean, I've seller financed some deals. I mean, it's similar vein, right? And the argument there is always, well, couldn't you just take the funds and 1031 exchange it into something else and continue building the equity? And the answer is, well, yeah, of course I could. But at the same time, there's also something nice about just collecting 10 or 11% on a monthly basis, not having to worry about it doing anything other than making sure that that check is landing in my account every month and it's secured by the real estate.
yeah. Yeah. And if it's good real estate and it's real estate, and it's a person you've worked with and know, a lot of those things are kind of like you want to do your underwriting, you're going to do your credit reports, you're going to check on the sponsor that's doing it. You're going to check on the asset, make sure they don't take out any additional loans against it. Like you have to do all those things, but at least you're in a position where you know a lot more about the asset than other people would.
Yeah.
And you know more than if you're just going out and investing in something randomly that you find out there. So yeah, I mean the seller financing route, as long as it's kind of a lower loan to value and it's an asset you've had and you've owned for a while, it's like, yeah, it kind of makes sense. You're going to get pretty stable returns out of it. In worst case, if it goes bad, the asset, you know what to do if you need to step back into those shoes.
Yeah, I mean, I think there's something definitely to be said for some of the wealthiest investors in the world. They move to the debt side at some point, right? They start to allocate more and more of their funds towards debt. Nathan is saying, wonderful discussion thus far, gentlemen. Nathan, thanks for joining us, man. Questions? Yeah, if you guys have any questions on private debt, on how this works, on making money in that, feel free to drop those in the live chat, and Dave and I will get over to those. So, Dave, what are your thoughts like moving forward in terms of the debt market? Like, if interest rates, like if the 10-year Treasury drops and it goes back to 2022 or 2021 rather, is this still as viable of an option, or like what are your thoughts there?
Yeah, I mean, it's funny how one chart can be so impactful to an entire industry that's like constantly, you're logging in, you're like, oh, where's the 10-year at? And it goes down, people start texting each other based on what the 10 year is doing. And man, if it goes back to like 2021, I think people should borrow as much as they can on that interest rate. Yeah, I mean, I think that would wipe out kind of any kind of debt product. You're not going to be able to renew stuff if you're paying 10%. Man, the debt markets go down to 2.7, and you can buy stuff. Like you should get what you can there.
Yeah.
I just don't know if it's going to go back down to that level. I think we're at a good interest rate level right now where you're in your 5 and 6% range. It's not crazy high overall that's out there, but it's also not basically like free money where people are just taking out as much as they can.
I know, man. If I knew then what I know now, I would have levered myself to the gills.
Yeah, but man, it is some people that are able to do that. It's still hard to, that takes some courage to do. See if you can.
Yeah, you don't know.
Yeah.
Yeah,
I feel that
still don't know.
they've had no debt on real estate. They're happy with it. They sleep better at night. It's like, yes, they got huge chunks tied up into properties, but you don't have a note payment. That's pretty nice. But on the debt front, I think there's two ways of looking at it as well. We've done debt deals where we've come in a typical partnership, right? Where you're going to get a K1 structure. You set up an LLC to loan specifically to a deal. And then you kind of have some of the benefits of pass through, but you're not getting any depreciation write-off. You're not getting any of those benefits of owning a real estate deal when you do the debt side. You're really just getting interest income that's passing through to you. And the other way we've done it too is where we set up a C corporation, right? So you think about like, yes, double taxation where the corporation has to pay taxes, but that's simply a 1099. That's way easier on a tax return standpoint. 1099s are coming out in like the middle of January, whereas K1s take a lot longer to get out and process and make your personal tax return more complicated. If you're looking to simplify your personal tax return, which sometimes these things you keep doing it, real estate investments and rolling 1031s and getting into other states and stuff, and then you look at your personal return and you're like, what the heck is going on? Why is this thing going to take so much longer and cost so much more to do? Well, welcome to the world of K1s across the country in various different states, you know. So we've looked at the 1099 route too, which has been, the tax treatment is different, but debt income is really just interest income. You know, it's flowing through both ways on that.
It's a nice way to simplify it. I'm sure you're like me. Every January, I have that one investor that immediately texts me as soon as January 1st rolls around, like, "Hey, where's my K1?" It's like we send them out every year at the end of March. We have done that every single year since we've had you as an investor. So
Yeah.
having those 1099s would make my life a lot easier too.
Yeah, we did a 1099 structure simply because we could get those out in January. And you don't, I mean, you can do a 1099 with TurboTax. You don't need to do anything fancy on your tax return front. You can do them quick. They're super cheap to file, and it's really the same thing. But you think about like the other route where you're getting a K1, it's going to take a lot longer and you're going to have a more complicated tax return. And but for that, you're going to get a little bit of a benefit because the corporation's not paying the tax part of it. But but yeah,
So so on the investment side, I've seen people try to do the debt thing by themselves. They do some private money lending on their own. And yeah, there's pros and cons to that. There's a lot of risk. You have to really know how to evaluate a deal. If somebody's interested in starting to collect interest income like this from real estate debt, how do they find a group and vet a group that they should be placing their capital with?
yeah, I think just going out and networking, meeting people is the best option possible. Asking for referrals and seeing like, hey, who's done this? What has been your experience? And have you actually put money into that thing? And how did it go? So on the private side, there's a lot of like you've got to, you're almost like your own salesman going out there finding like, how can I find people that are in this space and working here? And, in my role, like we've invested in the debt side and we've done our own debt stuff too. But all the opportunities came from being in the real estate space and talking to people, and all the opportunities to invest in something came from that same prospecting, sourcing of opportunities. So we never really relied on, hey, are we seeing an ad on a billboard for a CD? And we're going to go like, hey, okay, that sounds great. We go put some money in that CD over there. That's not how, that's not how we found those opportunities.
No, it's similar to LP equity, right? You just got to know the people. You got to know, man. That's what it all comes down to. What types of deals are you seeing out there? Like what types of deals are you interested in putting
Yeah.
debt on today?
You know, well, we've talked about this because we've always said like there's so much going on in your local environment. You don't have to go find the other, big moving city, or you don't have to do any of that. Like there's stuff happening right in your local environment, and talk to the people that are owners there. So I mean, our approach to finding debt opportunities is doing it with people that we know are current operators, that we've seen them do deals before. We've seen the cycle they've gone through, and we know the assets that they're working on. So we're not doing any new territory. We're not doing any new people. It's all stuff that is kind of right in our wheelhouse. So it's got to be in the neighborhoods. It's got to be in the areas we've worked in before. It's got to be with an operator that we have seen do multiple deals and that we know. That doesn't eliminate all risks, certainly, right? But at least you're able to then have comfort in what you're looking at, what you're doing, and the questions to ask, and you can go look at everything. So we still look at it that way. It's
Yeah, I would assume coming from the operator perspective, like you already know how to evaluate the deal, right? So that gives you a pretty good approach from there. And I'm sure too, it's got to be deals that hey, if this goes south, then we have to take it back. We know what to do here.
yeah, yes, yeah. It's got to fall in that camp because you're underwriting this just like tech. Like, hey, if I got to take this and do it, like, what am I gonna do here? Like one of the, I referenced one guy that we did a financing for in a multifamily deal. We did another one like that where we were renovating the units, and it was like, okay, if all goes bad here, we're gonna have to step in and finish doing these renovations, lease the units, and then you refinance or sell the deal. We'd have to step in and operate that, but we felt very comfortable doing that because we knew that we had been in the neighborhood the deal was in before for many years. So it would not have been a stretch for us to have to step in and execute on that business plan. And we really wouldn't have changed the business plan much from what he was doing anyways, where it's like, hey, you know, renovating a unit and making it nice. It's like everyone has a little bit of their unique flair of how they're going to do that. But in general, that business strategy of like go in and renovate the unit and lease it up, and we're very comfortable with that. So we could step in and do that. I think it's tricky if you're going to lend money and you don't have the ability to go, you know, to go run that plan. I probably wouldn't do that on the lending front. It's like you got to be able to step in and take action if necessary.
What does that process look like? Like if somebody comes in and they default on the note, like how
Yeah.
aggressive are you as a lender with regards to handling their default? And then, I mean, hey, if it gets to the point where you do have to foreclose and take, like, what does that whole process look like?
Yeah, that foreclosure route is lengthy, and when we look at the states, every state has different foreclosure laws that are out there. And some of them are much easier to complete that process than others. And every state is vastly different on how those laws work. But we were like, hey, if we're gonna loan on this stuff, there's some states that we're not going to go to, and there's some states that we will operate in. So we changed we look at that part of it. We've thankfully never had to do that. And hopefully our goal is if we know the operator and we know the asset and they start running into problems, hopefully they ask for help. We'd rather help them at the front end and be like, hey, we can give you some introduction, some tips. We can help with something on a process instead of going to the point of like, hey, now we're no longer talking and you got to go through a foreclosure process. So
Yeah, and you mentioned like a pref equity, pref debt kind of style earlier too. I mean, is there a way for you to take control of the project without having to go through a foreclosure project? Like, are there triggers that you could set up in the loan docs to where the debt converts to controlling shares of equity or anything like that?
yeah, I'm sure there's something on the legal side that could finagle that, but we've tried to keep ours very simple
Yeah.
on the standpoint of like, we don't want to send an operator like a 92-page debt agreement that they're like,
Well, or defeats the purpose, right? Yeah.
yeah, they're going to run it through AI and their attorney and have a million questions. And then we're going to do the same thing. So we're like, okay, let's simplify this. So it's like a document that, can actually be signed and we'd sign it from both sides. But really, we try to say, like, look, if you're running into an issue or we see the numbers are dropping on from a reporting standpoint, you know, ask us. Let's just talk about it at least to start with and see if there's anything we can do to change the trajectory of things. We're looking at deals too where we've loaned on projects that are going through that, and we're very involved in the project. We want to like, what can we do to help? What can we do to make this project better? How can we help that operator succeed? We want to see them be successful too. Even though we don't have upside on the deal, we just have our interest payments. Like, there are people in our world that we're going to run into on more and more deals as it goes. We want to be successful too.
Yeah. Yeah. Well, I mean, that's the thing, right? I mean, you want to set it up as a win-win. You want everybody to succeed.
Yeah, yeah, certainly. What are you the residential side, the fix and flip model, there's a lot of what I feel like was called hard money lenders that were in the space, and they would always, as soon as there's a residential deal that comes up, it's like, okay, what hard money lender are you gonna go to? Because you don't want a conventional loan for a long period of time. You gotta do this thing fast and get out of it. And you need a hard money lender that's going to kind of work with you and be good in that process. Have you run into any of them jumping into the commercial space, or they stayed on the residential side?
No, they really stay on the residential side. I think what tends to scare those guys a little bit is the dollar size. Because I mean, to be fair, commercial deals are a lot bigger. Right? If you're doing fix and flips on $250,000 homes and you're winning somebody 100 to $250,000, that's one thing. If you're getting into commercial and you're talking about, a $5 million project and maybe a check size of 1, 2, 3 million or more, I think that's what starts to get those guys a little bit nervous. But I have seen smaller groups like start up, these debt funds in kind of like the $5 million range, right? They'll do their first round at $5 million, go out and raise some funding from their investors, and then just slowly grow from there. So like specifically on the commercial side of things.
Yeah. Yeah, I think it's a very interesting space. I think it's underserved in the commercial side, and it is very tough right now to get a, call it like $1 or $2 million loan. you do like a 10 or $15 million commercial deal, there's a lot of lending options out there. But even at that smaller size, or if you want a 12-month loan on a commercial asset, that's going to be a hard loan to find. That's not very expensive from a complexity of getting in, reporting and exiting structure. That it's going to be hard to find. So, you know, we've looked at a lot of those, and we'd love to do more of them that are out there. But it's kind of hard. There's not a whole lot. There's not a lot of lenders, and there's not a lot of debt providers that are falling into that camp right now. So,
Yeah, I mean, it's a different beast, right? It's the same as like, hey, do you see residential agents jumping into commercial, or do you see residential contractors jumping into commercial? I think it happens, but they're so different, man. You really need to specialize in that.
yeah. Yeah, I mean, even that the one deal we're looking at in Chattanooga together, we're looking at like roofing quotes. It's like these are not these are not residential roofers. These are coming in with an army, and they knock that stuff out instantaneously. It's pretty impressive. So the lending side's got to be the same too. It's like it's got to be on the commercial side. It is pretty quick on done.
Yeah, I will say, like on the commercial side, I wish we could work with residential roofers and do residential style roofs. It would make my life so much easier.
Yeah, you learn a whole new terminology on the commercial side compared to the residential roofing. Of like how many letters? What are we talking about here?
Dude, it just makes you realize like how simple roofing is on the residential side. Like anybody can throw up shingles. I mean, when you start getting into TPO and flat roofs, it completely changes.
Yeah. Then you're like, all right, how much of this are we taking off and putting back on? You're opening up a can of worms half the time on those things. But that's what makes real estate fun. There's always some other angle of like, hey, how are you going to do this, and what makes it interesting?
Yeah. No, that's exactly right. Well, yeah, I mean, speaking of the Chattanooga Flex deal, we're going back and forth on that. That's something that we're hopefully going to bring out to investors here soon. What else you got going on?
Yeah, we've got I feel like there's always like some kind of aspect of real estate that you got to be like, hey, what is your playbook that you're going to run at the time? And you run that playbook a couple times, and then eventually other people have the playbook too, and you no longer run that play, right? So one of the things we're looking at right now is there's a big shift between the price point of, call it, the investment side of real estate deals. We have multiple users, multiple tenants, 100,000 square feet, down to, hey, I want my own couple thousand square foot building. So right now we're looking for some opportunities where we're seeing we can buy multiple buildings at kind of the discount, because like anything, the larger the scale you buy something, you're normally getting a discount. And then we're bringing those back in and then exiting those on an individual deal by deal basis. That's really been the driving force behind one of our big deals up in Chattanooga, that strategy where we can buy a pool of assets for cheaper and sell them individually. Now that's a lot of work, and you got to go put some effort into that, but that's how it works. It is work.
Right? If it was easy, everybody'd be doing it.
So we've got a flex deal in Lithonia, Georgia that we're bringing out there. We're doing this really the same plan on. Same plan we've modeled that we've done from our Chattanooga. We're buying multiple buildings and selling them off one at a time. So we have that deal that we're sending out now. And then our flex deal. We got once we get our flex stuff together and get that one out, that's gonna be a good one too.
Yeah, it'll be a fun one. Well, and I love that model too, because I mean, look, it's not as common for that to happen in the commercial world as it is in residential. Think about it. People have gone out and bought apartments, condoed them out, and sold off individual units. And you can do very well doing that because you're buying in bulk at bulk pricing and then doing legal work and flipping it. It's essentially the same thing for buying these flex campuses. I mean, there's a lot of owner operators out there that want to own their own little 10,000 square foot building or 5,000 square foot building, but they don't have those opportunities because who's out there really building those, that are specifically for an owner occupant? Not many. I mean, most people that are building 10,000 square foot flex buildings, they're renting them out and flipping them on a cap rate because you could do really well on that.
Yeah, definitely. Yeah, that early 2000s like condo boom that happened. That was I wasn't involved in it, but man, it was definitely exciting to watch. Like there was a lot of momentum in that space. That's a lot of the similar kind of thought process. Buy something bigger, divide it up, and sell the smaller pieces at a higher per square foot basis.
Yeah, it's a lot easier and faster than building something new. That's for sure.
Yeah, we also the other part is we've even found options where we can, on the debt side, where we're putting out loan options on assets that are even the sub $1 million assets. So you got a sub $1 million asset where you need a little bit of financing that's maybe like $100,000 or $200,000, even on the commercial side. And we started income fund that's basically doing that at those smaller scales. So we're getting uh, good rates of return on the principal note that's going out there. It is a 1099 investment style, but it's also like there's not a lot of debt options for those people that have a call it significantly smaller commercial deal. So we're looking at those opportunities as well.
Yeah, I like that. I mean, it's just, it takes some time being in the real estate market, but as old as real estate is, there are still always new opportunities that nobody has ever stepped in to really fill a gap on, right? And I feel like the private debt market, especially today, there's a lot of pioneering happening because people are finally starting to look at it and go, you know what? Maybe the way that we've traditionally been financing deals for the last 50 years doesn't work anymore. Like, what are the alternatives?
I Yeah, I mean, I think if interest rates just stay level, anytime interest rates stay level, like a lot more creativity and options can come out in the market, really whatever the level is. But if they stay level where they're at now for like another 12, 24 months, I think we're going to see a lot of creative private debt side opportunities that are out there that get built to, they're going to capture a little bit more margin, do things a little more efficiently than call it a bank at certain lending levels. And I think it's going to be good for the real estate investor as a whole.
Yeah, I think so too. It's always fun to see innovation happening in this because I mean, I swear, like since I got started in commercial real estate 2013, it has felt like the industry was stuck in 1982. Just not a lot has changed.
Sometimes things don't move that fast,
Yeah,
right?
and they really don't.
Yeah. Cool. All right, Tyler. Well, the next thing we're doing, we got our office hours on Friday, August 12th. We're gonna go through and answer any questions. Sorry, August 5th, but at 12 o'clock. Not August 12th at 5 o'clock. August 5th at 12 o'clock. We'll mix those up, make it nice and confusing. So
Hey man, everybody's got to have a little dyslexia every now and then.
they got big terms for those now. So that's good.
Yeah, that's right. Yeah, so office hours, August 5th, 12 o'clock Eastern. Y'all jump on. Feel free to ask us any questions about deals we've got going on, any questions you have about, projects you're looking at, investments, whatever. How much you should be allocating to your debt funds. We could talk about that. I mean, obviously we're not your investment advisors, but we've been in, we can give advice from our perspectives. And the office hours is always fun. So yeah, y'all tune in August 5th, 12th.
Cool. All right, Tyler. Great day today. Have a good rest of the week. All right.
Hey, you too. Good chatting with you. Appreciate you guys for joining us.
Yeah. Thanks everyone for joining. Really appreciate it.